Hello everyone and welcome to my fourth video on investment appraisal. This time I'm going to be looking at the average rate of return. Now the average rate of return is the average annual return on an investment as a percentage of the initial investment. So for all the money that's been put into this investment, on average each year, how much of a return are we going to get as a percentage of the money that we put in? So in order to calculate this, we need to have the cumulative cash flows for an investment project. So going through the years, cumulatively, how much money is it made each year? Now, it's very important that you are able to calculate this. If you are not in a position to do so, I suggest you go back and have a look at my other video on completing a investment cash flow grid in order to be able to do that. So we need, in order to calculate the average rate of return, we need the average annual return and the cost of the initial investment, and then we're going to multiply that by, divide the average annual return by the cost of the initial investment, and we're going to multiply by 100. And as an example, we're going to do it with this one. So to find out the average annual return on a thing, we need to find out what the profit is over the entire course of the project. Now, you can add up all the costs and all the revenues, and you can take all of the costs away from the revenues to give you the profit, or you can do a nice little cheat way. This has effectively already been done for you with the final cumulative cash flow. So if you go to the final entry on the cumulative cash flow, that will give you the profit over the entire life of the project. And then, if we want to find out how much it is by year, we need to divide this by the number of years. So in this case, this is a 3-year project. So we're going to divide our 7,000 by 3, which gives us 2,333.33 pounds per year of the investment. Okay, so now that we have this, we need to work out what this is as a percentage of the initial investment. There is sometimes in the exam they may give you this chart and they may ask you, you need to find the initial investment. Now, the initial investment is on here. If you saw my other video, if you go to the first cash out, this is the first big expenditure for the investment. This is usually the cost of the investment. So this £40,000 here. So we take this 2,333.33 and we're going to divide it by the cost of the initial investment and multiply by 100. And in this case, it gives us an average rate of return of 5.83%. That means for every year that this business is that has money in this investment, it's getting, on average, it's going to get a return of 5.83%. And this can be really useful for comparing different investment projects. So if you've got to choose between two projects, you can look back and say, well, actually, we're going to get an average rate of return that's much higher with this other project. Maybe that would be more profitable. So it allows you to make those comparisons. You can also compare it to the interest rate. So maybe if this was a little bit lower, maybe if this was like 2%, you might say, well, actually the interest rate, it's in the same kind of region and we'll get our money back at the end guaranteed. So maybe this isn't such a profitable investment. So you can make those comparisons based on obviously the risk of the investment compared with putting money in the bank, which has significantly less risk. There are some positives and negatives to using the average rate of return. So, first of all, it uses all the cash flows over the life of the project. Now, what that means is it's taken into account every cash flow from every year of the project. Some investment appraisal techniques don't do that, particularly the payback periods, because it only looks as far as the investment is able to pay itself back. So beyond that, it doesn't take that into account. The average rate of return does. So that's certainly one significant thing for it. It focuses on profitability. So unlike the payback period, this focuses on how much money you can make after you've paid off your costs. So it's focusing much more on profitability than purely the ability to pay its own way or pay itself. And it's also easy to compare investments. You can take that percentage, you can compare it to other average rate of returns from other projects, you can compare it to the interest rate, you can see how profitable any individual project is going to be. However, there are some downsides to the average rate of return. Now, because it takes into account a significant number of years, let's say this was a 20-year project, it could be less accurate. The reason for that is because into the future it's much harder to predict what's happening. It's much easier to predict what's happening in the short run than in the long run. So the later years which are involved in the average rate of return calculation may not be as accurate. So for long-term projects, this may be less useful. Or it'd be less accurate. So perhaps that it should be taken with a pinch of salt, as it were, as to what this is going to be. Also, it ignores the cash flow timings. These are purely on average. So, for example, we're making £7,000 in the final year here. According to this, we should be making 5.83% per year. But that's only when we reach year 3. So if something happens and the project stops short, actually this project will still be making a loss. There won't be any sort of profit to make from it. So it ignores the timings of when the inflows are occurring. And last of all, it also ignores the opportunity cost of the cash invested. Now, money could be put in the bank, and we consider if you've got £100 in the bank and you have a 10% interest rate, £100 today is effectively worth £110 tomorrow. The average rate of return doesn't take into account that. The only investment appraisal technique that takes advantage of that is the net present value. So that's something that's worth considering when you're thinking about different investment appraisal techniques. So to make a good investment appraisal, you should probably be using all three and discussing all of those effectively. Anyway, I hope that's helped with your average rate of return. See you next time.